Tiff Macklem of the Bank of Canada has penned an article in the Financial Post this morning ensuring Canadians that they are committed to keeping inflation at bay. And we're going to talk about the details of his letter, what this all means, and what the underlying tones of this letter really are and why it is being written now. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards the RESP, RSP, TFSA, to pay down their mortgage, pay down other debt, or simply do whatever you like with. In fact, go ahead in the comment section below, tell me what would you do with $5,000 if you had it. And in order to win it, just remember, you have to be subscribed. It's free, it's easy, and it's definitely worth it.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
Okay, so let's get into it. Let's discuss Tiff Macklem's letter. And I'm going to deviate a little bit from the normal program here because I'm going to go through this letter in detail, paragraph by paragraph with you, and talk about what Tiff is saying and why he is saying it at this point in time. Because this letter has a lot to do with the psychology of Canadians and really putting them in the right mindset so that they don't do something that becomes a self-fulfilling prophecy and encourages inflation to ramp up when it shouldn't. So I'm going to pop you right into the screen here. This is the article. I'm actually going to go in and make sure that we get it all zoomed in for you as well. And as you can see, the headline is Tiff Macklem, Bank of Canada, remains firmly committed to keeping inflation under control. Rising prices due to pandemic gyrations unlikely to persist. So what he's saying here is really simple, that all of the inflation numbers for the last 3 months that have been above 3%, now they're 3.1 this month, they came down off of May's highs. Those are not going to persist because quite frankly, they have the situation somewhat under control, and they also understand that a lot of the reasons why inflation is seeming to be higher is because how much prices went down last year. So let's run through this paragraph by paragraph. You know, it's not going to take very long. Stick with me till the end because I want to tell you at the end of this video exactly why they're having this conversation now with Canadians. So, as the third wave of the pandemic recedes and vaccinations rise, Canadians are feeling the sense of relief and renewed optimism. That is definitely for sure. We see people going out, spending more money, although not as much as they were spending pre-pandemic, but there's definitely a sense of relief out there. And even though things are getting back to normal, they systematically go out to Canadians to survey them to figure out how people really feel. And one of the big things that came back with respect to how people feel about the Consumer Price Index is that it doesn't necessarily represent how Canadians feel about what's actually going on in the economy. So as a result, Statistics Canada, and this is moving into the third paragraph here, has updated the baskets of goods that makes up the CPI to better reflect what people are actually spending money on. Now, what's interesting here is that even with this update in June, CPI was 3.1%. And even if they hadn't changed the basket of goods, CPI still would have been 3.1% using the 2017 basket. So what that tells us is that the inflationary numbers and what's reflected in the CPI basket of goods, even though it wasn't necessarily as accurate as Canadians would like, when it was redistributed to make it more accurate, inflation still stuck around the same numbers, which means it's still a pretty good indicator of what's going on in the economy with respect to prices. Now, obviously, the Bank of Canada's mandate is to use the inflation rate and stick within a certain bandwidth. It's between 1% and 3%. And they use typically interest rates. And when things get really bad, quantitative easing, which is injecting money into the economy, buying bonds, that sort of thing, specifically buying government bonds. They use that to affect inflation. And if you lower rates, inflation should go up. And if you increase rates, inflation should go down. Now, that's all else being equal. Obviously, if we see a ton of growth come out of the economy and the economy collapse in the same way that it did in the pandemic in 2020, then what happens is you start to see that the money that they're injecting in the economy doesn't necessarily increase prices. It just gives people, consumers, the funds that they need to buy goods that are already at the existing prices, or in the case of last year in 2020, at largely lower prices than what they were previously. And he goes on here to talk about why inflation is higher now. It's mostly because of unique circumstances of the pandemic. Prices for many goods and services plunged last year. Today's inflation rates compare prices now with their depressed levels a year ago, which makes the numbers and the increases seem more dramatic. But what he's saying here is that 3.1% increase in inflation it isn't actually the real number. It is, yes, it's based on the previous year, but the previous year with those lower prices and the depressed prices, gas going down to 80 cents last year and it now being $1.40, whereas the year prior in 2019, it was around $1.30 or $1.40. That is what's causing those increased numbers and basically a lack of reliability on the CPI index because it's overshooting what it should be looking like. Now, he talks here about gasoline being 80 cents a liter in March of last year. It's $1.40 now. And, he goes on to talk about that not being the only reason why the inflation numbers are high. So in other words, the deflated prices compared to the prices now. He talks about the disruptions in supply lines. He talks about the fact that it's been harder to get semiconductors. It's been harder to get certain goods transported across the world. Combine that with what happened in the Suez Canal, and things have been just harder to ship, harder to get. And when supply reduces, prices tend to go up because there is not enough supply to meet the demand, which means people have to pay more to get the things they want. And this includes everything from semiconductors, which have affected the price of cars, to lumber and housing, housing affecting the price of lumber and whatnot, to, all other sorts of goods in the economy. And, with some products being scarce, you saw that a lot of prices have been driven up. And here's the thing. At the very end of this, what Tiff says, and this is the line right here, is all of these factors have driven up prices. So the decreased prices in 2020 due to the pandemic, supply shortages, supply chain issues, all of these things have affected prices, driven prices up. And that's what's causing inflation to be at 3.1% instead of the 2% they would like it to be. But what he is saying is that none of this is likely to last. In fact, they are very clear and they're very concise in their determination that come 2022, we should see inflation back around 2% when all of those baseline months have filtered out and when supply chain issues have basically sorted themselves out, which we're starting to see now. We're starting to see supply of a lot of things come back online. We're starting to see lumber prices come down. They're down 70%, which is a pretty huge drop in prices. And that is largely due to the fact that the demand in housing has subsided because people are able to go back to work, back to doing things outside on their patios, back to doing things outside, not on their patios, but on other people's patios, like bars and restaurants' patios. And things have just generally gotten back to normal, which means there's less demand for those single family homes, and therefore lumber prices have decreased. And also the self-improvement, home improvement boom, not self-improvement, but the home improvement boom has basically died down as well because people are now spending their money back at restaurants rather than making a really nice patio for their friends to sit on. So basically what he is saying here is that inflation should move back inside the target range by 2022 as businesses work through temporary factors as a result of the pandemic and so on and so forth. And, this is true for going back to the 1920s during the Spanish flu. This is true after the First World War, the Second World War. Anytime the world sees some sort of global crisis, it takes a year or two for things to get back to normal. And if we assume that the pandemic started in 2020 and we say it takes 2 years for the world to get back to normal, that puts us at March of 2022. That's generally when the economies and things are going to be back to where they were prior to the crisis, prior to the pandemic. So it's a really interesting conversation. Now, let's talk a little bit about why this conversation is happening now and why Tiff is writing this letter and why they're so adamant about ensuring Canadians that inflation will remain under control. And it's because of this. It's because inflation is one of those things that can become a self-fulfilling prophecy. So if Canadians believe that specific goods are going to go up a significant value in the next 6 to 12 months, what they'll do is they'll start buying those goods as fast as they possibly can in order to purchase them prior to the prices going up. And what that does is the higher demand creates higher prices because supply can't keep up, and therefore inflation becomes a snowball effect, and it just gets bigger and bigger and bigger. And this is what we saw in the 1970s and the 1980s, where people were literally buying things when inflation was at 10 and 12%. People always talk about interest rates being at 10, 15, 20%, but they often forget to mention the fact that Inflation was also at 10, 12, 15, 20%. And what people were doing was simply buying stuff prior to the prices going up, and that was just exasperating inflation. So what they're trying to do is they're trying to say, hey, listen, guys, we've got this under control. Cool your jets. You don't have to be going out buying things. You don't have to be worried about inflation. It's going to come back to normal, with the hopes that Canadians will accept that messaging. And I know a lot of you on the YouTubes here have trouble accepting that messaging, but that messaging is the reality unless something else happens, which is the something else being a self-fulfilling prophecy sort of scenario. And ultimately, you know, if we can just keep it under control until March, April, May, or June of next year, then inflation will be something that they're able to control, and things will get largely back to normal from an inflation, a cost, a living perspective, and also from an interest rate perspective. So if you found this video useful, do me a favor, hit the subscribe button, hit the notification bell, hit the like button. I'm not going to talk about the courses that are in the description below today, because honestly, this one is a little bit more of a heavy message when it comes to what's going on in the economy. But again, do me that favor and hit that subscribe button. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next and hopefully a little bit more upbeat and more exciting topic. Cheers.